We have a big risk, a major risk, and most people are dismissing the risk. So let's take a look at the financial cycle. And the financial cycle is the most important aspect of the long wave because it leads in determining the direction of the economy. And it's extremely important to the business cycle. Now, I've mentioned, I think you've seen this chart here, where the peak in the financial cycle, and this occurred 2 years ago. That was the bottom of interest rates, and then of course it leads GDP or the economy, and then the price in labor. All that means is just inflation and labor costs, which are an important aspect, right? So we've already said that it peaked 2 years ago. And most importantly, we looked at the updated leading indicator, right? We're in the growth recession area, not real recession, but it's there. This indicator has a perfect track record. So does a yield spread. It's simply because liquidity is tightening. We've seen here at previous tops in 2000, 2007, 2019, a recession followed. Definitely a slow and dramatically, and this one is actually very extreme. So what is the components of the financial cycle? Obviously, number one is rise in interest rates. We live in a credit-based economy, and if the price of the price of credit is rising, it will put strain on the financial economy, which is the most important part, is the real estate economy. And this is why we're seeing asset prices around the world correct, right? Because interest rates are rising. So there's number one. And it's really important to understand this. Number two, we've seen this chart, which is a contracting of money supply. Money supply is extremely important. Simply, again, it's the liquidity coming into the system. Now, remember, all of these lead. They're not lagging like GDP. We'll know in a recession after the fact. So these are lead indicators. The opposite was true. We know that there's a recovery in the future. So and it takes a while. I think Lacey Hunt alluded to it could take anywhere from 9 months to 2 years, and that's what history says. So we can see that the second component is contract. Now, the third one, obviously we can see with the latest data we have in Canada. Now, I can use credit growth, household credit growth, but most of that credit growth is in mortgages and HELOCs. And we can see the secular slowing heading toward a deleveraging at the latest by the 2030s. So we see the trend again. It's slowing. So it's a combination of those three aspects that make for a financial cycle that is restraining liquidity. And we can see that. Again, we have a financialized economy. So the most important aspect of that is its price, in this case, credit. We can see evidence of that money supply contracting, and we can see the evidence that credit growth is slowing. Until these indicators turn around, this is the reason for the high allocation to cash. No matter the markets, I think there's a short covering going on because earnings are deteriorating, but the bottom line is that this is the reason for why we're so bearish, and I shouldn't say why it's really me and the model. Okay, so I hope that makes sense. Nothing is changing here. The credit cycle continues, or the financial cycle continues to contract. You can see that in the banking sector, the real estate sector, anything to tie to the financial sector, and it leads the economy, and it's working its way through. As we know, 20% of mortgages are being reset at much higher rates. So that's going to have a huge impact on the economy with inflation and, of course, rising taxes. We just have the perfect storm for 2024. As always, any questions, please like and subscribe. And if you know somebody who would be interested in a perspective for the long wave, let them become aware. I think I know they'll be extremely informed. Anyways, until next time, thanks for watching.